recorder on here. Okay. So learning objective 2 in chapter 13 is going to introduce you to two types of analyses. The first is called horizontal analysis. The second is called vertical analysis. And again, you do not have to be standing up or lying down to do any of these. Ha, ha, ha. Okay. But basically what we're analyzing are the financial statements. We need to actually make sure we have some type of base in which to compare, right? And so they have base, you can use intra-company, intercompany, and industry averages to do your comparison to how your company is doing. And we're going to be looking at things from within inside the company, okay? Again, the basic tools, horizontal and vertical analysis, are part of learning objective 2. What we're going to be doing next week and what your project is on is something called ratio analysis, which is a bit more detailed in depth. So that we get to next class. Horizontal analysis is also called trend analysis, okay? Can you spot trends, either increases or decreases that have taken place over a time period to the accounts either on the balance sheet or on the income statement? Because those trends might give you an idea, right, of how you should be evaluating the data. So let's see how this looks. The first thing we're looking at here, a horizontal analysis for Chicago Cereal Company, okay? I don't know if you're cuckoo for Chicago cereal, but it could be one of these things. Here they have the balance sheets for December 31st, ending on December 31st for both 2013 and 2014, okay? And what we're looking at basically is we're noting the changes in the accounts from the base year of 2013 to the newest year, in this case, 2014. Now, in this case, the current assets increased by $290. Well, of course, it's in thousands. Because when you get from 2427 and you get to 2717, you have to go up by 290. Because you went up by 290 on a base of 217, that means that your current assets increased 11.9% over that period of time, okay? $290 represents 11.9% of the base, 2427. Are we okay with that? So, and they do this for everything. So property assets.
How do you get that 11.9?
You take the 290, you take the difference and divide it into the base, which is 2427. Okay, we were able to do that? All right, so here we have property assets listed in 2013 at 2816. In 2014, it was 2990. That's an increase of 174. Well, an increase of 174, so Jen, this is for you and everybody else. 174 increase on a base of 2816 is a 6.2% increase, okay, from one year to the next. Other assets, the base was 54.71, went to 56.90. That's an increase of 219 over a base of 54.71. That's an increase of 4%. And when you look at total assets went from 10,714 to 11,319. That's a change of 683. 683 divided into the base year of 10,714 gives you an increase of 6.4% in that period of time for total assets. So as you see, current assets really increased a lot. Other assets only increased a little bit. And the average for all assets increased 6.4% from 2013 to 2014. We do the same thing for the other part of the balance sheet, liabilities and stockholders' equity, right? In 2013, we had current liabilities of $4,020. In 2014, that went to 40,044. That's up 24. 24 divided by the base of 4020 means that your assets here, your current liabilities barely rose. They rose less than 1%. 0.6 is the same as 0.6% increase. Okay, it's a small increase. Long-term liabilities went
Did it
from,
make nothing to eat?
I'm sorry? Oh, did you have a question, Claudette?
I was wondering how you get the percent.
Okay, so in this case here, we're doing, let's go back to our current liabilities here, okay? We had a $24 change. And it's so hard to write on these things. On a base of 4,020, 4020. I know that looks horrible. And that came out to a decimal 0.00597, etc. Okay. Now that's the decimal. To go from a decimal to a percent, you have to move the decimal place over by 2 places, which means the decimal would be here. And so the decimal would look like that, 0.59. But in this case, they're only rounding to 1 decimal, so 0.59 rounded to 1 decimal is 0.6. Does that help?
Yes, I just wanted to know how you end up with the percent, but now I see.
Oh, okay. Yeah, that's how we do it.
Okay.
All right, so for the long-term liabilities here, we had a base of 4625. We had that increase to 4827. That's an increase of 202. Take the increase of 202, divide it over the base of 4625. That's a 4.4% increase from year to year. And when you look at total liabilities went up by 226. Divide that into the base of 8645, and liabilities went up in total 2.6% from 1 year to the next. And you do the exact same thing for stockholders' equity. Common stock was at 397. It increased to 493. That's an increase of 96. 96 divided over 397 is a huge increase, 24.2% increase in common stock. All right, that's really big. Retained earnings went up even more, started at 2584, increased to 3390. The difference was 806. 806 divided by 2580, 84 gives you a 31.2% increase. Okay, that's a huge, huge change. Okay, this is interesting because this is our cost to treasury stock. And remember, treasury stock shrinks stockholders' equity. So here we started with 912 of treasury stock, and now we went up to 1,357. So in other words, we actually have 445,000 more in treasury stock than we started. So when you take the 445 and divide it by the 912, you'll see that treasury stock increased 48.8%. Okay, that's a huge increase. So when you look at total stockholders' equity, went from 2069 to 25.26. That difference of 457 divided by the base of 2069 meant that stockholders' equity increased in total 22%, 22.1%. Big increase for stockholders' equity there for this company. Once you total up the liabilities and equity and you compare year to year, you had a $683 difference divided by a base of 10,714, which meant that total liabilities and stockholders' equity increased 6.4%. It should match. Okay. So this is horizontal analysis for a balance sheet. This is horizontal analysis for an income statement. Okay. So this is an income statement, again, showing the years ending 2013 and 2014. And again, in horizontal analysis, we're noting the difference from the base year to the to the most recent year. The difference is going to be listed here and going to be divided by the base year. Okay. So here we had net sales go from 10,907 to 11,776. That's $869 higher than it was. 869 divided by 10,907 is an 8% increase in net sales from 2013 to 2014. Did you want me to go all the way down? Anybody?
No,
you
got
don't
it.
have to.
Got it.
But I
did the whole thing with the balance sheet, so I figured you guys you should be able to catch on a little bit. But basically, the difference between the base year and the most recent year, right? You take the difference and divide it back over the base year. That's how you get the percentage. Okay.
Can you actually go over the other income expenses there where it has 2 and 13?
Yeah, sure. Okay. Yeah, this is an odd one, right? This is an odd one because what happened here is, yeah, I'm glad you asked this. You had other income at 13, which is a positive number here, going to a negative number. So to get from a positive 13 to a negative 2, here's that number line, right? You have to lose 15 places. Yes? We okay with that so far?
Gotcha.
Okay. So negative 15 divided by a positive 13 gives you a negative change in the result. So that negative 115.4 is simply the negative 15 divided by the positive 13. Now let me get my calculator out. So we have a negative 15, sorry, divided by a positive 13. And what you'll see is 1.1538. Did you see that in your calculator? 1.1538. And we're only rounding to 1 decimal, so that's 1.15 becomes 115 because you're moving the decimal 2 places to the right regardless, right? And that 0.38 is a 4. So that's where they get that. Is that okay?
Yes, thank you.
Okay. And in this case, when we actually went down, right, our income tax expense is higher in 2013 and 2014. So the difference went down. And so this becomes a negative number divided by a positive denominator here. And that's how you got the negative 5% here. Okay. So how fortunate to have all of that. So that's basically horizontal analysis in a nutshell. Okay, I'm going to go back to the big screen briefly, see how you're doing. So horizontal analysis, you're taking the difference between the base year and the most recent year, and you're calculating the difference, the percent change. Are we good?
Yeah, so the base year, you're calling it a base year, so it doesn't have to be consecutive. It doesn't have to be 13 to 14, right? It could be like 2004.
18 to 19 or 19 to 20. Yeah, I mean, whatever the first year is, you're comparing that to the most current year. That's
But the first year
difference
doesn't
between-
have to be just last year, right? Like, what if you wanted to see over 10 years? Are you saying that the
You
base
could
year
do
could
that
be?
too. Yeah, you
Okay.
could do that too.
Okay.
It's a lot more complicated to do that. Yes.
Oh, you can't just do the
Oh,
same
you
thing?
can.
You couldn't?
Yeah, you can just do it over and over again. I'm just saying, but it's complicated to think about it here right now with this chapter
Oh,
because
okay.
I'm just starting with one small step for mankind and one giant leap for Excel experts and financial
Okay.
analysis later.
So,
Right,
yeah,
we
so we
good?
don't ever have to do that. Yeah.
No problem. No problem. All right.
I
So
have
that's
one question.
yes.
I'm
Absolutely.
sorry.
No.
If we go back to the Chicago cereal company where the other income was negative, how do we get, if the base year was 13, but the recent year was -2, how are we getting -15?
Well, because when you start at a positive 13
Okay,
and you subtract out, well, and when you go from a positive 13 to a -2, you have to go 15 places to the left, which is
okay,
minus
okay.
15.
All right, okay, I got it.
So it's just sort of following it, and then we need to add a negative sign.
Okay, all right. Thank you.
Sure. Okay, so we're going to do now, that was the horizontal analysis, and I see everyone's still horizontal. Now we're going to go vertical. Are you ready?
Ready?
Okay, grab the puppies. Okay, so vertical analysis here basically is a technique that expresses each item on the financial statement as a percentage of the base amount. Okay, and so that's basically what we're going to be doing with the balance sheet and the income statement. Okay, we're going to be looking at a base amount, which for say a balance sheet would be like total assets. So how much current assets as a percentage of total assets, property, plant, and equipment as a percentage of total assets. The total assets is the base, and we're looking for the percent, the fraction that is current assets or property, plant, and equipment. For the income statement, we're looking at revenue as the base because everything on the income statement gets subtracted out of revenue, right? Revenue starts everything. We take out all of the expenses. What's left is net income. Net income is a percentage of revenue, just like all the expenses are a percentage of revenue. So the revenue is going to be the base amount. Everything else is going to be flowed as a percentage of that base. So you'll see how that works. This is exciting, very exciting. So again, here, vertical analysis, percentage of the base. So this is, we're going back to Chicago cereal, okay? And here is the 2013 balance sheet amounts and the 2014 balance sheet amounts listed under the amount, okay? The column that says amount, these are the amounts. My arrows are not working quite well right now. To the right of that is the percentage, and this is where the calculations come in, and it's not that bad, all right? So again, like I told you, we are looking at total assets. The total assets are the base of the assets. What percentage of current assets, our total assets are current assets? And so $2,717 out of $11,379 means that current assets are 23.8% of the whole amount of assets they have. For property assets,
Do that over again.
Yeah, I'm going to repeat, actually I'm going to be repeating it over and over again. So I'll do that one more time here. So we're looking at the base of assets, okay? So let's just focus on 2014 for now. They have $11,397 of total assets. They have $2,717 of current assets. What amount or what percent of the total assets are current assets? So you take the current assets and you divide it by the total assets, and you get the percentage. So when you take $2,717, which is the current assets, and you divide it by the base of 11,379, you're going to see that current assets represent 23.8% of all the assets this company had in 2014. You're going to do the same for property assets over total assets to get the 26%. 2,990 divided by the total assets, it's 11,397, means that property assets represent 26% of all the assets that company had in 2014. These that wonderful other category, don't you love that? Maybe I should have another child. I just name them other, because it's a general category. So I would have $5,690 of other assets out of a total of 11,397 of total assets. My other assets represent 50% of all my assets. So is that clearer? Let me just open up the little windows here. Is that clearer? Can I get some thumbs or other movement or?
Yeah. So you're just going to divide down.
Pretty much. The
And
base is gonna, the base
and
is
that
gonna- the
that
base
100
gonna be
is
your
all
total.
those percentage added up?
Yes, ma'am.
Okay.
Yeah. So when you look at just the assets for 2014, right? 23.8% of all the assets are current. 26.2% of all the assets are property assets, and 50% of all the assets are other. 23.8 plus 26.2 plus 50 is 100. They are
That makes more sense when you say it like that.
They are going to add themselves down. They're doing the exact same thing for the total assets for this year. Okay, so this year, 2013, they had $10,714 of total assets. So the current assets divided by the total assets means the current assets are 22.6% of all the assets that company had in 2013. Their property assets were 2816 over total assets of 10,714, means that their property assets were 26.3% of all their assets in that year. And as you see, their other assets were quite large, 5471 out of 10,714, which means that when you divide these two numbers, other assets are actually 51.1% of all the assets for that year. When you add up the percentages for these three assets, you're going to get 100%. Just like you would if you added these numbers, you're going to get that amount. All we're doing, this is the actual number, we're just breaking it into percent, so they're going to be equal. Okay. And of course, we do the same thing for liabilities and stockholders' equity, except the base is the total liabilities and stockholders' equity. This is the base that you're comparing to, right? So for 2014, I'll continue breaking this down half and half here. You had current liabilities of $4,044 out of a total liability and equity of $11,397. So that means that the current liabilities are actually 35.5% of all of the liabilities and stockholders' equity in the total. Long-term liabilities were 48.27 out of a total liability and equity of 11,397. That's a 42.4% amount of the total. when you look at all the liabilities, 8871 total liabilities compared to the total liabilities in equity, that represents 77.9% of the entire liabilities in stockholders' equity. Okay, so that's quite a lot. Then you do the same thing for the categories under here for stockholders' equity. Common stock was 493 out of a total of 11,397. It's a very tiny 4.3%. Retained earnings was 3,390, a larger number, over the total of 1,397. You're going to mean that that's 29.7%. Okay. Now here, remember, treasury stock is at cost. It's a negative number. So don't forget the negative sign. So negative 1,357 divided by a positive 11,397 means that your treasury stock was eating up 11.9% of your equity and liabilities in total. Okay. Total stockholders' equity was 2526 divided by 11,397 means that the total stockholders' equity was 22.1% of the total liabilities in stockholders' equity. Well, again, you can look at it a few ways. Total liabilities, 77.9%. Total stockholders' equity, 22.1%. 77.9 plus 22.1 is 100%, guaranteed. You can also do it the long way. Add your current and long-term liabilities together, add all of these together. Don't forget, the 11.9 in this case is negative. You'd still get your 100%. So no matter which way you wanted to add them down, you're always going to add to the base. Same thing over here. This is again, this is vertical analysis, but for the income statement. Okay? So this is an income statement for the year ending July 31st. For 2013, the numbers are here in the amount. For 2014, it's in the column listed amount. Okay? So in this case, the income statement's different because everything starts with revenue and then flows from that, right? Your revenue is going to cover all your expenses and give you a profit. So in essence, your expenses are a percentage of your revenue and your profit is a percentage of your revenue. The revenue is the base. The revenue is the base. So in this case, your sales revenue is going to be the base. That's your 100%. Everything is going to be compared to the sales revenue. Okay. So cost of goods sold in this case, and I'm only looking for the 2014 numbers here, $6,597 of cost of goods sold on $11,776 of revenue is 56% of your revenue is cost of goods sold. Are we okay with that? The difference, right? Sales revenue minus cost of goods sold gives you gross profit. The gross profit of $51.79 compared to the net sales of $11,776 means your gross profit is 44%. Now that should bring you way back to chapter 5 because we did a gross profit margin and that's how we did it. No change, no difference. You've already done that piece. Selling and administrative expenses were $3,311 out of the total of $11,776, which is 28.1% of the whole. Income from operation, remember in this case, this is the profit from your operation, $1,868 divided by 11,776, which means that it's 15.9% of your revenue. Interest expense was $319 out of a total of $11,776, which means your interest expense is 2.7% of your revenue. In this case, this is such a small number, right? -2 over that larger number that it just rounds to 0. That's all. Your income before income taxes, that's your profit before your taxes, was $1547 on 11,776. That's 13.2% of all the revenue is your income before tax. You paid $444 of tax on 11,776 of revenue. That's 3.8% of your revenue was sucked up in tax. And you had a net income, that's your net profit, of $1,103 on $11,776 of revenue, which means your profit was 9.4% of your revenue. Okay, and the same thing in this column. Do I have to review anything for anybody? Is everyone okay with that? All right, so one thing you can actually do when it comes to vertical analysis on income statements, particularly important, right, is you can actually start comparing companies. Right? So Chicago Cereal is a cereal maker, just like General Mills. So that's what they do. That's their main business. So even though General Mills is a much larger company, this is in millions, Chicago Cereal is in thousands. So obviously this is $17.9 billion. This is only 11,776,000. Big difference in that. But when you break it down in percentages through vertical analysis, you can actually see how they're doing, if they're competitive or not. And so that's what this does here. This actually gave us the, this is what we went over, because this is for 2014. This is what I went over with you on the last slide. And these are all the percentages that came over from that last slide, okay? Does everyone understand that that came from the previous slide? Do you believe me? I'll go back. See, here it is right here. See that 11,776 and the 1101? I'm sorry, 1103. They're right here again. They're right there. You see them? We follow?
Yes.
Okay, that's important. Wanted to make sure. So we know that cost of goods sold for Chicago Cereal is 56% of revenue. We know their gross profit is 44% of revenue. Okay. We know their selling and administrative expenses are 28% of revenue. We know their net profit is 9.4% of their total revenue because it's all broken down there. This is a small company. How does it compare with a very large company, General Mills? Well, just do the same thing for General Mills and put them side by side. So in this case, General Mills has a massive amount of sales, $17 billion, $910 million. It's a lot of sales, but that's your base. That's your base. They have cost of goods sold of 11,540. When you divide that by your base, their cost of goods sold are 64% of their revenue. Well, compare that to Chicago Cereal, whose cost of goods sold is only 56% of their revenue. So Chicago Cereal has a lower cost of goods sold compared to General Mills, which has a much higher cost of goods sold. When you look at the gross profit for General Mills, it's 6,370 on 17,910 of revenue. That's a 35.6% gross profit margin. That's pretty good. But when you compare it now to Chicago Cereal's 44% gross profit margin, it's not as good, right? Obviously, Chicago Cereal's in a pretty good position. They're competitive here when you look at it that way. All their selling and administrative expenses, 3437 compared to 17,910 means that their operations only cost them 19.4% of their revenue dollar, Clearly, Chicago is smaller. It's sucking up a lot more of its operating expenses per dollar. So because General Mills is so large, it benefits from what we would call economies of scale, which means they might be able to control their costs a lot better because they're so large. Here they have a non-recurring charge or gain. That's a small percentage. Here's their profit from operation. 29.58 profit from operation on 17,910 is 16.5% profit from operating. That's a higher profit from operations than Chicago Cereal. So they actually have a very profitable operation there, and that's good. I can't see this anymore, so I'm going to erase. So let's keep going here. They have other revenue and expenses that were 6.3%, but of course the big number is their net income, 1824 compared to revenue of 17,910, which means their net income was over 10% of every dollar they received in sales, because 10.2% of a dollar is roughly 10 cents on every dollar. And that's a higher profit margin, net profit margin, than Chicago Cereal. Okay. So we're going to leave out the frauds for now. And then the do it exercise is listed here on page 659. Okay. So if you're in your book, you want to go to 659 to get the do it exercise at the bottom. And the do it exercise at the bottom is actually short, which is good. This is some information regarding a company called Rose Patch. They have their current assets, other assets, and total assets listed for the years 2016 on the right, 2017 on the left. And they want us to do a horizontal analysis of the percentage change, assuming 2016 is the base year. Okay, so our current assets increased from 180 to 234, which means they increased by $54,000. $54,000 increase on top of a $180,000 base is a 30% increase in current assets. Plain assets should be plant assets. See how it has plain here versus plant? This should not be, you know, de plain. So, little tattoo joke there. Yeah. Anyone remember like Fantasy Island stuff? Just years and years ago. De plain. Okay.
Yes, I do.
Thank you. So you remember that. So they had 420,000 of plain assets and plant assets, and that increased to 756. That's a whopping 336,000 difference on top of a base of 420. 420, get it? The base of 420. Shit. And it is 420 today. I don't know. Hope no one choked up at 420. But here it is. It's an 80% increase in plant assets. And that's anything but plain. Total assets, 600,000, increased to 990. That's a huge increase of 390 over a base of 600. So total assets increased 65% in that period of time. Okay,